All right, brace yourself. Next year, everything from how much interest you can deduct from your mortgage to the tax break that you get for your children will literally change overnight. That's if Congress doesn't extend the Tax Cuts and Jobs Act of 2017, which is set to expire at the end of 2025. Joining me now is Lisa Greene-Lewis with TurboTax to go over what you need to do to prepare. Thank you so much for joining us. Let's jump right in here. We're talking about a tsunami of potential tax changes that will impact nearly everyone. How so?
There are a variety of ways. So when the tax reform occurred, 5 out of 7 of the tax rates, so those are the tax rates that your taxes are based on when you file your taxes, those were decreased 1 to 4%. So if nothing happens, those will go back up to what they were before. Also, the standard deduction, so that was doubled under tax reform. So if nothing happens, the standard deduction could go back to where it was, which was half. And that moved prior to tax reform, about 70% of tax filers claimed the standard deduction, and under the changes, it moved to about 90% of tax filers claim the standard deduction. So less were able to itemize, which brings me to there were some itemized deductions that went away that could come back. So unreimbursed employee expenses, those went away, but they could come back. And those are like your expenses if you're an employee that your employer would reimburse you for, like working from home. Right now, only self-employed can get a deduction if they work from home, but that could change. One big one I want to point out, if you live in a high property tax state, so under tax reform, there was a cap of $10,000 for property taxes and state income tax combined. So those living in those high property tax states, they were only able to deduct $10,000. That could go back to where there's no cap.
Okay, and quickly before we let you go, I do want to get this in here. What steps can taxpayers take right now to prepare for the potential changes? Is there any specific strategies or adjustments that can help minimize tax liabilities to avoid any surprises?
Yeah, if you're expecting more income in 2025, you might want to capture that income or incur that income in 2025 because the tax rates, just want to be clear, it would change in 2026. It wouldn't be 2025. So if you're expecting a larger bonus or you want to get some more retirement income, you might want to do that in 2025 if the tax rates are going to change.
All right, a lot to keep track of. Lisa Greene-Lewis, appreciate your time this afternoon. Thank you.
Thank you.